All right, guys. So, welcome to the third episode of the Cesar Rivera Show. Today, I have the pleasure of being joined by Keila Hill Trawick. She is a certified public accountant and owner of Little Fish Accounting here in Washington, D.C. Keila, welcome to the show.
Thank you very much for having me.
Cool. All right, Keila. So one of the reasons I have Keila on the show today is to really discuss, the recent changes to the tax laws and how that's affected a lot of people's tax returns this year. Also, we're going to discuss, tips on how to best prepare yourself for the 2019 tax season as well. So, Keila, if you don't mind, can you tell my audience a little bit about, what you do and the services that you provide?
Sure. As you said, I'm the owner of Little Fish Accounting. We are a CPA firm that's based in DC, but we have clients across the country. And essentially, we provide accounting, bookkeeping, and tax services to what I like to call tiny businesses. So that means sole proprietorships, very small LLCs, partnerships, anyone who wouldn't normally have an accounting department. They can be freelancers, entrepreneurs, people who are doing side hustles, but basically any accounting needs that someone would have for a business that's relatively small in headcount, even if they're making money revenue-wise.
Gotcha. So one of the things that I prior to this show, I reached out to a number of individuals and wanted to, ask them about, their recent tax returns. And I specifically focused on individuals who either, they're W-2 employees, meaning they're, straight salary. B, their income has not changed at all. It's pretty much been, stable for the past couple of years, either maybe a slight increase of $1,000, $2,000, nothing more than that. And then B, nothing has changed with their family status as well. So, if it's a single individual, or if it's a couple, married couple, or married couple with a couple of kids, their status has pretty much been the same. Nothing has changed in regards to that. And, the funny thing, with talking to these individuals, a lot of them told me that their income tax return has changed this year in regards to either them, getting a slightly or greatly reduced return and or actually owing this year than in the past. So can you talk about what has caused these recent changes to people's tax returns?
Yeah, I mean, it depends on several factors, but one of the major things that happened in this past year is that because of the tax and jobs cut, a lot of internal payroll withholding tax systems were changed. And what that means is when you work for someone, there's an estimated payroll calculator that's kind of chugging along behind the scenes to make sure that they are taking out enough tax for you throughout the year to get you as close to zero as possible. So that's partly dependent on your exemptions. You put in how many exemptions you have, and the tables behind the scenes say, okay, based on this, we think we should be taking approximately X per check out. Last year, those tables changed. The assumption was that you would owe less in taxes for the year, and so the payroll withholding tables took out less in taxes throughout the year. If you didn't make any changes to your exemptions, so for example, let's say last year you claimed 2, and this year you claimed 2. Last year, 2 exemptions took out a lot more money throughout the year than 2 exemptions this year took out. What that meant was at the end of the year, you owed the same in taxes. If your tax burden last year was $10,000 and not that much change, you essentially would owe $10,000 this year. The difference was this year, based on the tables, they may have only taken out $8,000 in taxes throughout the year instead of, say, last year they took out $12,000. So I had a lot of clients and friends who one of the easiest ways you could look at that is to look at your W-2 from 2018 and look at your W-2 from 2017. And what a lot of people noticed is that the federal withholding box was significantly lower in 2018, meaning they took out less, but the IRS doesn't care. They say, well, you still owe us the same, in our example, $10,000. So you have to pay the difference. That seemed to be a lot of the change. One of the other changes that happened that you alluded to and that we'll talk about a bit more is the change between the standard deduction from 2017 and standard deduction in 2018. So that deduction was doubled. You essentially got to take an automatic deduction of higher in 2018 than you could in 2017. But along with that, the new tax situation removed exemptions. And so that didn't change for most people who were single or who were married. That didn't affect you too much because the standard deduction doubled, which made up for the fact that you didn't have exemptions anymore. But specifically for people who had 2 or more children, before last year, you were able to take the standard deduction. And in addition to that, you got approximately $4,000 per person in your family. 2018, you no longer had that. And so that was a huge chunk that would have reduced taxable income that people weren't entitled to anymore.
Gotcha. Now, what would you say, when it comes to the withholdings, for example? I felt like that was a very confusing topic for most individuals. Most people don't really understand how the withholding process works. Before being a 1099 employee, I was a W-2 employee. However, I did have the opportunity to speak to my CPA and kind of talk, in a little bit more detail in regards to like, how can I keep more of the money I make in my paycheck every month versus, maybe at the end of the year when I do my taxes, get a return. And I think that's it's a certain mindset that people have when it comes to a tax return versus, having more money in your pocket. Everyone feels a little bit different. And I remember listening to you and everyone, I found out about Keila in a NPR interview that she did. And in an interview, she said, and I want to misquote you, so I wrote it down. You said that people are used to getting tax returns every year and they use it as an indirect savings account. Can you elaborate a little bit more on that and what you meant by that?
Yeah, I am in the camp that believes that tax refunds aren't necessarily good. I don't think that they're bad, but I think that people don't really understand what refunds actually represent. And so to our example earlier, if you owe $10,000 in taxes, you are going to pay that. Either you're going to pay it throughout the year or you're going to make up the difference at the end of the year. But at the end of the day, your tax burden remains the same. And so I think a lot of people really underestimate what the tax refund is supposed to do. It's not free money. It's getting your own money that you paid in back at the end of the year. And so people who either don't understand or don't want to think about that tend to be really excited about tax refunds because it acts as kind of an indirect savings account or bonus. I know in April, I'm going to get this huge chunk of money that wouldn't normally be coming to me throughout the month. And I get to kind of use that as I want to in a specific period. But what they don't realize is that that is directly affecting the cash flow that you're getting throughout the year. And so, yes, you end up getting this chunk, maybe hundreds, maybe thousands of dollars in April, but that is money that you could have been saving for yourself throughout the year without giving it to the IRS, is what we like to call a loan. And so one of the things that I like to bring up when people are thinking about their refund is the process of receiving a refund isn't necessarily a bad thing, but you want to understand what that actually represents. If it makes more sense in your lifestyles to get your money throughout the year, then you can't be dependent on a refund at the end. It's one or the other. Either you get your money every check or you can get your money in April. But I think a lot of people were kind of expecting that they would receive the same refund at the end of the year without really paying attention to the fact that their check was a little bit higher every 2 weeks or every month when they got paid because not as much tax was being taken out throughout the year. And so I want people to have a better understanding of like, this is what your refund and your owing means. The fact that you didn't get a refund isn't necessarily a bad thing. It just means that there were some calculations throughout the year that didn't act in your favor at the end, but you don't necessarily owe more. You just didn't pay as much throughout.
Gotcha. Now, with these conversations that you have with clients, have you seen a change in mindset in regards to people maybe now not caring so much about getting a return, or you still get pushback like, you know what, yeah, that's cool, but I still want to get my check at the end of the year?
Yeah, I mean, I think I've been able to educate a lot of people, which has been really helpful. I think not getting a refund was kind of an eye-opening experience for people to start asking questions to say, whoa, how was I getting a refund in the first place and I'm not getting it now?
Mm-hmm.
It's a bit too early to tell. It's the first year. I've had some people ask about changing their withholdings,
Mm-hmm.
but then kind of feel like they don't want as much taken out throughout the year and are making a more informed decision, but maybe still deciding to go for a refund at the end.
So as a realtor, I do have a lot of individuals who are looking to purchase a home, of course. But one of the major, benefits for home ownership outside of just, not being tired of paying rent, is the fact that in the past you were able to write off so much of, certain items when it comes to, being a homeowner. But with the recent tax laws, those things have changed a little bit. So can you talk about what has changed in regards to, and when I talk about the tax laws, is really in this case itemized versus the standard deduction, and how that affects a homeowner currently now, someone who's looking to purchase a home now, or a current homeowner.
So one of the things that I think people have to have an understanding about is what a standard deduction versus itemized deduction really means. And so a standard deduction is the flat rate that the government gives you. For individuals this year who are not married, it was approximately $12,000. Itemized means that you get to take advantage of any expense that you're entitled to as an itemized deduction. And there's a fairly long list that got shorter this past year of the things that you were able to take advantage of. But specifically when it comes to home ownership, we're looking at mortgage interest and real estate taxes. Previous to this past year, you were able to deduct as much as you paid in real estate taxes. So almost an unlimited amount, essentially, as long as you tallied up what got taken out of your check for state taxes and then what you paid in property taxes to the state, you got to deduct that in total, in addition to any mortgage interest that you paid. This year, that state and local deduction was limited to $10,000. So on people who live in higher tax areas, it's less beneficial for them because, for example, if you paid $20,000 total in state withholding and property taxes, that was going to be limited by half.
Mm-hmm.
The other change is that because the standard deduction was doubled in 2018 as opposed to previous years, a lot of things that you are technically entitled to wouldn't count. So I'll use myself as an example. My husband and I bought a house. We are entitled to the interest and the real estate taxes, but the standard deduction was so high, and you're always going to take the larger of the two. So if you calculate out what totals to your itemized deduction and what the standard deduction is, you are automatically able to take whichever one is bigger. Our standard deduction was bigger. For some people, that means that they feel like, well, then I lost all of the itemized deductions. Everything that I was entitled to before, I don't get anymore. That's partly true, but that's not really the angle that we want to think about it. Really, you're still entitled to them. It's just that if it's not bigger, you're not going to take advantage of it. This comes up not only with real estate, when we think about charitable deductions, all of these things that you add up. If you're a single person that bought a house and you add all of those items together and it doesn't come up to more than $12,000, you're just going to take the flat rate anyway. So I'm sure in your industry, you've seen where people have talked about whether or not that's beneficial to them, but it's not as direct a cut, besides the limitation that we have now. It's not as direct a cut for itemized deductions as I think people automatically assume it is.
Yeah. I mean, and the main thing for the people that I talked to, I mean, in the past, the huge benefit was, there are, some of these individuals, do make a substantial income, and they, went about purchasing homes to reduce their taxable incomes because of the write-offs. Now, and this is kind of another segue I wanted to go into, is a lot of those individuals are looking at purchasing investment properties now. It's just a topic that's come up a little bit more than it, for me at least, in the past, where most of my clients were looking to purchase a primary residence, even a second home. But now the conversation points have been more so about purchasing investment property. And from my understanding, because I don't want to talk about taxes because I'm not a certified personal accountant, how did the recent tax law changes affect people purchasing investment properties?
I think it just made people start thinking about other ways that they could lower their taxable taxable income. And so one of the ways that investment properties are beneficial from a tax perspective is that expenses that you might not otherwise be entitled to, you get to take advantage of when you have a rental property. And so, for example, normally you would not get to deduct utilities or lawn care or PMI. There's all these items that you normally wouldn't get to deduct, but if they are as a part of a rental property where you're gaining income from that, you get to offset that with these expenses. I think some people assume that maybe they're not going to receive as much in income as they're paying out in the maintenance or payment for the home. And so if that ends up being a loss, they get to match that against their W-2 income and bring down the taxable amount that they would have been assessed on.
Okay.
Otherwise.
Actually, I want to talk a little bit more on that. So it was actually something I was meaning to ask my CPA, but since I have you on the show, I can ask you personally. If you have an investment property and you actually have a loss, you're saying that you can offset your personal W-2 income by some of the losses from your investment property?
So one of the things that we want to remember is that it's all going on the same tax return. So you're not making a direct, like, I made this much throughout the year and I'm going to take this amount off. But when you look at your tax return, you're going to have a line for wages and salaries, and you're going to have lines for items like business income and losses and also rental income and losses. And so when you go to file your tax return, that's going to come up as a negative, which kind of directly and indirectly lowers your taxable income, because now you have an amount that you're not getting taxed on that reduces the amount that you would have otherwise been taxed on.
Okay. So it's the taxable income more so
Exactly.
than anything else. Okay.
Exactly. But you'll still see them as two separate line items on your tax return. It's just that it's going to be on one form.
Mm-hmm. Now, one of the other things that I don't think people know when it comes to investment properties, also outside of just, your interest, I'm talking about mortgage interest, property taxes, but then also what also goes into offsetting the income that you get from a rental is depreciation too. Mm-hmm. I don't know can you elaborate a little bit on depreciation? Sure. Like, I know about it, but I don't like talking about it in detail. I rather rely on a professional like yourself to discuss that and how that works.
Yeah. So depreciation in its very simplest sense is the reduction that you get to take for kind of use of the house. And so you take the amount that you paid for the house, and you have the same thing with houses and equipment, anything large that you buy. You have the option to say, I'm going to deduct for future years my wear and tear, as you will. So we're going to look at it. Usually for houses, it's 27 and a half years. You're going to take the amount that you paid, divide it over that number of years, and you get to deduct that amount each year as a expense against your rental income. Mm-hmm. And so a lot of people don't think about it directly because you're thinking about the expenses that you actually pay out. But that's another one that's kind of a hidden expense that you get to take advantage of that also reduces the amount that you're taxed on. Mm-hmm. One of the things to remember is that in order to take those deductions, you have to have income. Because it's passive activity, you have to be making money from the rental property. You can still end up with a loss, but mm-hmm. You can't just have a rental property that doesn't actually bring money in and take advantage of being able to deduct all of the cost of maintaining that home.
Gotcha. And I guess if someone needs to talk a little bit more on depreciation, I'll just refer them to you to discuss that a little bit more. So one of the other things I did wanted to discuss here would be just in general, like if someone wants to work with you specifically, I know you have a boutique accounting mm-hmm. firm, but would you work with individuals who, I'm just trying to figure out who is the ideal client for you? Like, would you work with an individual who's W-2 employee, mm-hmm. I'm just giving an example here, single guy, W-2 employee, doesn't own a home, doesn't have a business or anything like that? What would you recommend that individual to do? Would it be beneficial for them to meet with you, or should they just go and do a simple TurboTax tax return on their part because they don't really have to need, or TurboTax seems a little, simple and easy to do
Yeah.
versus maybe paying someone, a large chunk of money to do their taxes and stuff.
Agreed. I definitely tell people that you want to pay for what you value. And so there are definitely people who feel up to date enough that if they go through a TurboTax or some DIY tax program, they feel like they can at least hit the nuances if there's anything different to be able to catch and make sure that they're getting the best value out of preparing their own tax returns. I like to tell people that I'm an accountant, I'm not a wizard. And so if you don't have anything that's super complicated and you feel comfortable with it, I'm not against TurboTax. If you want someone to look at it, if you want someone to prepare it for you, some people just want the peace of mind of knowing that a CPA looked at it. If there are any questions, I have a resource that I can go to, and we're here for those people too. But I think that it can go both ways. We definitely have individuals who don't have businesses, who are just kind of living and just need tax prep assistance. We also help clients who want to do it on their own, but would like to have kind of a second set of eyes on it to make sure that before they send it out, it has and is doing everything that they expect it to. But I definitely do not squash for people who want to do it themselves, because I think there are plenty of tax situations and accounting situations that you can kind of handle without assistance. We just want to know that you have a resource available if you have questions or want to ask something.
Gotcha. And then the other question I usually ask everyone that's on my show is if there's any, resource that you recommend. Usually I ask like, what's a book recommendation for anyone who's trying to understand, taxes in general, or a resource that they can go to better understand and maybe help prepare themselves for the 2019 tax season. Do you have any recommendations that you could tell my audience?
Yeah, absolutely. People are surprised to hear this, but the IRS's website is kind of robust when it comes to kind of keeping people up to date. Some of it can get a little bit tedious, but for the most part, if you have a question, especially with the new tax laws, they generally have a place that you can go. Perfect example is they have a withholding calculator that you can go online and include all of your information, answer a few questions, and it'll tell you what you should put in as your withholding number, which is excellent for people who don't know where to start.
Okay.
Also, Little Fish just started a podcast. So
Okay.
they have a podcast called Fish Food. They're very short. They're about 10 minutes a piece, but we try to give some kind of foundational information there too. And as we come across resources, try to share those as well. My goal is to make accounting as accessible as we possibly can. And so by the time you get to me, you basically have better questions because you have a baseline of what you understand and what you don't.
Gotcha. Awesome. And what I'll do is make sure at the end of the podcast to have all your contact information in our show notes to go along with, your social media sites, anywhere they can go about reaching you. But if you don't mind, can you tell them like quickly where they can reach you at via phone or email address?
Absolutely. So if you want any information on the business, what we do and how we service people, you can go to our website. It's littlefishaccounting.com. We are active on Instagram at littlefishaccounting. And if you want to set up a consult, there's a link directly on the website. If you have any outside questions that you want to send, you can reach us at hello@littlefishaccounting.com.
Gotcha. All right, Keila. Well, it was a pleasure having you on the show today. Thank you for taking time out of your busy schedule to meet with me, and look forward to talking to you in the future about other tax related ideas, and maybe we'll do something a little bit more segmented toward 1099 people who are actually individual business owners, and talk about how to go about your taxes in that sense too.
Absolutely. I'd be happy to do that. It was a
All
good
right,
talk.
cool. Take care.